my mind. Looks like we're in the click, click, click.
What is going on, you guys, and welcome back to episode 5, Cinco, as you were saying, Dad. Episode Cinco of our portfolio building series. What's going on, Dad?
Hey, having a good day here, Brian, in lovely sunny Powell River. No smoke up here from the fires, so we're escaping that so far. So that's good. Just a beautiful day, and was looking forward to doing this recap with you today. It's been a while, a few weeks, I guess, since we did an update on the portfolios. So looking forward to sort of updating everybody what we've done, where we're at, and go from there.
Yeah, I think actually looking back, it's been a month since our previous upload, I believe. I think. So
End of June.
Yeah, end of June. So we do have a lot to kind of catch up with you guys on. A lot of new additions, all sorts of stuff. I was actually just by your area. I was on the other side of the water, Campbell River, when we drove by.
Yes, you were just almost a stone's throw away across the water. You're up doing some fishing.
Yeah,
Jesse was saying you got a pretty good haul. It looks like.
Yeah, not bad. And we got a bunch of food to kind of eat for a while now, so that was good. Why don't we start with just doing an overview of our portfolio in terms of starting with just the total account size.
Sure.
And as of today, when we took a look at these numbers, our new portfolio total is sitting at $45,000 and $45,974.22. Up on the screen, you'll be seeing a clip here of our Questrade portfolio. This is the self-directed margin account. In Canadian dollars, this one's sitting at $22,811. Moving on to our Wealthsimple trade account, this account is sitting at $23,162. This is our personal cash account with 11 positions, and we're going to be diving into all of that towards the end of the video. But before we start getting into our Q&A segment, one of the things that we're really starting to recognize, Dad, as our portfolios have now been open for a little while, is we're starting to see this activity flow in. And in particular, it's nice to see these dividend payments as passive income investors that are starting to essentially create this snowball effect that even with just in a few months of starting this portfolio, we're already reaping the benefits from.
Yeah, because we're basically almost 3 months into it now, and so we're going to start seeing those dividends, which are typically paid quarterly by most of the companies that we own right now. So yeah, it's awesome. I think you have a screenshot. I think you put together for this. Yeah,
we're looking in this Wealthsimple account in particular. We have Bell Canada with the $14 dividend. KL paid us just under $5. Q-Tip got a nice $2 dividend payment. MUB, our other bond fund, CNR $5, MFC $11.20, and Q-Tip again and $2.03. So nice. This little, I don't even know how it's a great feeling, and especially for those that are on Wealthsimple, you do get a little notification by email saying you just received a dividend, and I can see that getting annoying with time, but especially when you're just getting started, it's an exciting little email to get. You can log on and see the action, so you love to see it. It's just proof of this whole system really starting to work.
And we're in those early days, and sort of think of that snowball analogy where the dividends today are like a couple of little flakes being added to the snowball. But months from now or years from now, those will be really meaningful as the portfolio grows and grows. And of course, most of those dividends as a percentage are going to increase as time goes by as well. So little now, but this is where you start, and looking forward to a couple years down the road having a look at these numbers as they're flowing in.
That's one of the things that when I started working for you at the firm and I saw some of the dividends alone that clients were pulling in, like there are some significant chunks as your portfolio grows larger and larger and larger. And it doesn't, you don't just skip to that step. It's all baby steps till you get to that point. So
a lot of clients would live off the dividends for the most part. But it's not just for older people living off the dividends, as you know. This is forming that base of the portfolio, and so even for a younger investor, chip away, and then at the time you get a little bit older, you're going to have that nice recurring dividend income coming in. So it's for the young investors. It's for the old investors.
It's a wonderful thing.
It is.
Let's bounce over to our Q&A segment. We had a ton of great questions come in, and we're going to be highlighting a few from you guys today. Let's quickly knock off one from Andy Scheid. Sorry. Thanks for this update. I appreciate your explanation and leaning towards bonds. What percentage bonds do you intend to hold? And cash now 40. He says, go Habs, go. Mark, glad you won't be wearing a Bruins cap in the next few videos.
I
probably
just
won't
have to take a quick moment because in the last video, that was when Montreal was going into the Stanley Cup Finals, and I think you and I bantered a little bit, and I mentioned that, oh yeah, I wasn't a Habs fan because they used to beat the Bruins back in the day. And to be very clear, I am absolutely no longer a Bruins fan.
Nice.
For many years I became very disenchanted with my beloved Bruins, and so I haven't been cheering for them for a long time. So there's a bit of a misconception there. I know the Habs did not do very well. I think they won a game in the series. Is that right?
Yeah.
So that's all right. So yeah, I got a lot of flack on that, but hey, I'll unless the Canucks are in there.
Yeah.
But
sorry.
but it's a Canadian team, so I think that's the theory. We're supposed to go with the last surviving Canadian team, right?
I think so. Back to Andy's question. He says, what percentage of bonds do we intend to hold? And I think the answer to that is we will definitely have targets, rough targets, but I think it can absolutely vary depending on the market conditions. Do you have any set numbers, Dad, that you'd like to share?
Well, what I like to think of it, rather than a target number, is a band that you'd work. So you'd have sort of, you're right, like a strategic target of, we have two separate portfolios combined into one. So in the growth-oriented portfolio, we will have a lower weighting of bonds. I would say probably at most times, I would expect that we would have somewhere between 10 and 20% in bonds at almost all times, just because we believe that having that element of the negatively correlated generally asset class to equities, it's good to have that in there. We've got some higher yield bonds in the portfolio, so they won't be the same generic Government of Canada bonds that we might have in the balanced portfolio, but probably in the 10 to 20% range, dependent upon where we are in the market cycle, what the markets are doing. So we'll adjust that. For the balanced portfolio, I would expect once we're fully built up, minimum of 20, probably a maximum of 40, let's call it generically in the 30% range. That's a number that in a balanced portfolio seems to be, it does the job it's supposed to do in there. Yes, you over time will sacrifice some growth, but the type of investor who would have a balanced portfolio compared to a pure growth portfolio, you need that in there just because most people don't have the temperament or the fortitude to ride through major market corrections, and that's exactly the role that those bonds do play, and they do add income to the portfolio.
Yeah, and if it's the role of the balanced if it's a role in the balanced portfolio, which is what we're attempting to build on the Wealthsimple account. Dave asked a question. Yeah.
One quick point there, Brandon. Andy also asked about cash. And cash right now is high because we put the money into the portfolio and we're building it up. But in the growth portfolio, once we're fully built up, and I think we're probably looking over the next couple or 3 months to get to that position, we would be looking at 0 or 5% cash, maybe 10. And in the balanced portfolio, I wouldn't shy away from holding 20% if the markets are rich like they are today, or going right down to 0 or 5% when the markets do correct, because that will come along. And that's exactly why you have that cash on the side. You sacrifice today, but then you take advantage. So probably, definitely, Andy, the 40% today is not something that we would expect to be holding for much longer at all.
Agreed. That's just temporary. Dave Millard asked, since your portfolio is based on long-term investments, do you place a stop loss on any of your picks? Simple answer, we don't at this point. Doesn't mean that we may never do stop losses, but no, we don't. We
haven't, and it kind of makes sense with a young portfolio like this because we're picking companies that we're hoping will be in the portfolio for a long time, with the full understanding that anything can happen in the short term. And in the companies that we've owned so far, we've seen some go up, we've seen some go down, some gyrate, and that's exactly what you would expect in this short-term nature. So no, you will find people who say every position should have a stop on it. I just don't believe that. I just think managing the portfolio, it's an unnecessary step in most market conditions, and I think to your point, this is a longer term perspective. That may change if we have one of these companies that shoots up, or when we have a certain amount of growth where the portfolio, we're worried about it being overvalued. I wouldn't preclude putting a stop loss on some of the positions at some point, but right now we don't have any, and it would just be market conditions that would dictate if we go that route or when we go that route. Anything to add to that, Brandon?
I would just say another consideration too is that we are this is what we do full time here, and we're actively involved with our portfolio. I'm not saying that we plan to watch over it every single day, and we're not on the computer screen checking the charts.
Yeah.
But that is something to factor in with a stop loss, in the sense that we are for the most part on top of what our holdings are doing, and. It'd be a different story if we were very busy with, another job or a different type of work, and we were going on vacation for X amount of days, and we weren't going to be in touch with these accounts, and we say, you know what, maybe we will place a stop loss here on a position, knowing that this is what we're willing to bear. Yeah. But given the nature of what we do and our business here and how involved we are with the markets, I think another thing is that we're quite on top of things. So I don't see us even having a need in the future, but as you said, we won't count it out. You never know.
And that's what you just said when we selected this question. That was something I forgot to say. But yeah, vacation. If you and I went on a vacation together and there was nobody around to manage things, then that would be the perfect opportunity to selectively put some stops on some, whatever names you're concerned might be a little bit overheated.
Exactly. Let's move on to maybe one or two more questions here before we go into the actual stocks that we did add. I forgot to mention, by the way, guys, if you enjoy this series, please take a moment and drop a big thumbs up. Also, make sure you're subscribed. Check out our Investing Academy. You guys know the drill. The next question can be from Kelly Halderson. Here's a good one. Question: if you were buying an investment for 10 to 20 years, how much do you care about your entry point for a stock? I hear about discounted cash flow, etc., and building in a margin of safety, but won't you end up missing out on a great company that never fully corrects, and you miss out on those returns if you don't just buy in and dollar cost average, or is that more your strategy? I think that's such a really, really good question there by Kelly. Essentially, to summarize, do we set? Let me reread that question back. Do we care about an entry point for our stocks? I'll speak on that first.
Sure, yeah.
I think the entry point always matters for your stocks.
Yeah.
I think it's a foolish thing to say, well, I'm investing for the long term, so it doesn't matter when I buy my stock. I think that's very dangerous. Entry point does matter, and we could probably throw up some cases. Let me just throw up a case right now. For example, you look during the tech bubble, like a Cisco or even a Microsoft, or for example, very strong companies. But if you bought them at the peaks of their bubble during the early 2000s and pushing into the 2000s, that entry point mattered. Even if you did believe in a company for the long term, and for 20 years or 17 years, you could have been in the hole. And we may be seeing companies right now that have done so well. They're at the peak of a bubble, and if you buy it now, the next 5, 10, 15 years, it could be a downhill from here. So the entry point does matter, but if it is a great quality company, to kind of play devil's advocate with that, there can be times where it doesn't matter, and you just want to get exposure to a great company knowing that it's going to go up. So it's a bit of both, but I'm curious to hear what you think on this, Dad. Yeah,
and I think that's what Kelly's... I think that's what he's saying is, in other words, do you set a target price, an entry price, and say it's $42.12 and it's at $42.13? Do you say I'm going to be disciplined and not buy it? Like what you just said, Brandon, to add to that, and I lived this as an investment advisor for quite a number of years, where I would have some clients who would set those very, very strict target prices, and I saw it where you think, wow, just like you're going to pay a fraction more for this company if you want to put that it's trading here and you've got that limit order here, and then you miss out on the opportunity. Exactly what Kelly's talked about there. So it's a very insightful question. To answer it, the answer is you have that. Yes. It does matter, even if you're a long-term holder, at what price, but to the actual penny or even close like that, our strategy is no. You want to get a piece of those companies. You don't want to, the next high, and then maybe it'll pull back. And even, we'll be talking a little bit more of that as it turns out, because we're going to be covering a couple of companies that we own to the portfolio over this last time period. And we've been wanting to own them since we started this challenge, and we've just added them just recently because exactly what you're talking about. There's an opportunity that we see right now. Again, we'll talk more about it in a few minutes here. But so wrap it up, Kelly. Great question, and I hope we answered it to your satisfaction.
I think a skill to develop. Just one final addition there is, as an investor, being able to identify when a company has fallen into an undervalued range or an undervalued territory, or conversely is trading in an overvalued range or an overvalued territory, I think that's a far more important skill than what people would realize. People think they have to get down to the penny, like you said, or the dollar and say, hey, my models say I need to buy at this price. It's this or nothing. This is how I'm going to get this return. I think more than that, if you're able to identify ranges and say, hey, this is a stock that is trading in an undervalued territory or an overvalued territory, I think that's actually a major little gem and point that you can take with you to help with, at least, again, depending on everyone's strategy. Some people like getting very, very into the numbers and crunching the Excel spreadsheets. Some people don't, but just personal preference there.
And we will have, if there are other portfolio managers or there are other advisors watching this video, they may disagree. Everybody has their own strategies, but Kelly ended with, is that more your strategy? And our strategy is, you want to get close, but we're not gonna potentially miss out on a great opportunity to try and eke out an extra penny. I'm not going to do that.
Agreed.
Yeah.
Let's do one more here by Joni Salsa Guthrie. Can you explain why stock prices go down during the ex-dividend date? And this was actually the question that spurred my video. I forgot where the question came from, but I knew there was a question. And I did a video, which I'll link up for you guys, which was the ex-dividend dates and really understanding the various dates. But we did have a reply to that comment from someone named Hughes, who actually did a really good job of explaining it. He said the ex-dividend date is the day that locks in who gets paid the dividend. And with the markets being efficient, with adjusting prices, it causes the stock typically to drop by the amount that the dividend is paying out. Makes sense that people who buy the stock after the ex-dividend date don't want to pay the same price as they don't get the dividend payout when that happens weeks later. So that kind of summarized my entire video. I did about a 15-minute video, but there you go. There's one sentence, and he did a really good job of explaining it. And
thank you to Hughes for kicking in and helping that out, because it was very, very well explained. There's that mathematical adjustment that is, and Hughes said, typically done. It doesn't mean every day if a $2 dividend is paid off, the stock's going to drop by $2, because there's other factors every day that are going into it as well. But all else being equal, you will see that adjustment.
Yeah.
And thank you to both. Thank you for the question, and thanks, Hughes, for helping out with the answer.
Yeah. If you guys have any questions for next month's session, or whenever the next session is, leave them down below, because we read them and we'll clip them, and hopefully we'll be able to feature yours in an upcoming episode. But thank you guys for the comments there. Let's move on now, Dad, to our exciting new purchases. And we had some new additions. We had some bump ups of existing positions. Do you want me to go over the holdings and then maybe you can speak on a couple? Or
Sure. Yeah.
Yeah. Well, then very quickly, let's talk about this. In Questrade, we added 5 shares of Baba. So that's Alibaba stock. This is a stock that's I've been getting a lot of questions on recently, and rightfully so. This and Tencent. We could make a dedicated video on this whole China topic right now, because it's actually getting more and more a little intense. Wealthsimple portfolio. That's all we bought. That's all we bought in the Questrade portfolio, actually, over the entire month.
Sorry to interrupt, Brad. For those of you who maybe didn't see the earlier videos in the series, Questrade is our growth-oriented portfolio, and Wealthsimple is our balanced-oriented portfolio, all combined. But so if you're just tuning in now, a little bit of perspective on that.
Thanks. Yeah, that totally slipped my mind. I forgot to mention, but you're exactly right. So that is more of our aggressive portfolio, shifting over to Wealthsimple, more of our balanced income-generative portfolio. The shares that we added were Canadian Utilities, bought 30 shares. We added Clorox, 3 shares, CNR, 5 shares, 25 shares of TD Bank, new holding, and as well 17 shares of Royal Bank. So why don't you take over on let's talk about the banks for a moment, because these are 2 brand new additions. These are brand new additions to our portfolio, TD and Royal Bank.
Okay, let's talk about the banks, and this kind of it piggybacks off what we were speaking about earlier about buying a company, and at what price do you finally take the plunge, and how strict do you want to be. I can't remember how many decades literally I've owned the banks, TD's, Canadian, Royal Bank, and others from time to time. But I think our Canadian banks form a core of most investors. Whether you're a growth-oriented investor or whether you're a balanced-oriented investor, they're just such a critical part. And one of the reasons is the dividends. And from time to time, these banks have gotten up to really, really substantial dividends. Both TD and Royal Bank right now are paying reasonable dividends of around the 3% range. Royal Bank right now is at 3.43%. TD Bank is trading are paying a dividend about 3.8%. So that's something, and the bank dividends tend to be very stable. When we go through the financial crisis, we went through the financial crisis, which seems like yesterday, but man, that was 13 years ago now. In that range, there were some dividends that were suspended or held up for a little bit. So they're not guaranteed, as all dividends. No dividends are ever guaranteed, but we like that as an element, and we believe that most Canadian investors with a reasonable risk tolerance should have some banks. When we started this portfolio, we started with nothing, just cash. So we looked at what we would want to enter or put into the portfolio at the time. One of the first places we would go is to the banks because we want them in there. I want to show you a chart here, and I know in some past videos I've talked about what's called the relative strength index. Now, to be clear, we are not technical traders. We believe, and there's technical fundamental or sort of the competing interest in some cases, and a lot of investors will be one or the other. We believe a mesh of the two is best. We always start with the fundamental look at a company, and if we like what the company does, we look at there's a runway ahead of them, and all those types of things. Are they profitable? Then that will be the starting point. Then we'll look for, okay, where are we in their cycle? Because all companies go through cycles. So one of the metrics that we do typically look at is what's called a relative strength index, or RSI is what you're going to hear. And I'll put a chart up on the screen here. At the time that we started the portfolio, you'll look at the chart and it shows a couple of horizontal dotted lines. The top red line, you'll notice on the right-hand scale, is at 70. And the bottom line, which is green, is at 30. Generally speaking, those ranges are considered to be overbought or undersold. So anything above 70, using this one indicator, would indicate that that particular stock at that point in time is overbought. It's priced above where it should be. Conversely, when you see at the bottom end, and the green line, if it dips below 30, that's considered to be oversold, and it might indicate, if all else is going well, that it's a good entry time. So when we started the portfolio, both of these companies were trading at quite close to that 70 level, and in fact both went over the 70 level shortly into the portfolio. So we've been watching them quite closely, looking for an opportunity, if you will, to add to those positions. Well, just recently, both of those companies have pulled back. Royal Bank pulled back about 3%, somewhere in that range, fairly recently. And over the last month or so, a little longer than that, TD Bank has pulled back actually closer to 7%. And from the recent peak to where we are today. When we looked at that, because we're always looking, what are we going to add? We're looking at what's been down as a starting point, and then look at, why is it down? Is it temporary? If it's a permanent thing, obviously we're not going to want to put those into the portfolio. But with the banks, we noticed that. Looked at the RSI, and if we look back at the RSI chart that we had on the screen, Brandon, we'll notice that recently TD did in fact dip below that 30 number. And Royal Bank never came quite that low, but it did come back down from the overbought territory. So when we kind of factor those in, we want to own the companies. Our analysis of the companies says that they are good long-term holds or stable companies. They pay an attractive dividend. Almost back to where Callie was talking about earlier. Yeah. How long do we wait? And hey, nothing to say that these companies won't pull back further than where they are now, but we found it to be attractive, and we thought, well, let's get them in. We're building up the portfolio, and we took a pretty good position on each of these, which they're almost at their full position of where we'd want them to be in the long term. So that's kind of the thought process behind adding TD and Royal Bank at this time, and I hope that kind of adds a little bit of perspective. The other ones you mentioned, Brandon, Canadian Utilities, that was a new position we took. And with Clorox and CNR, we already owned those positions, and we just bumped up the position to a little bit larger weighting in the portfolio overall.
Yeah, I think that, like what you just said there about Kelly, the entire time you were saying that, I was just thinking in my head, this all ties back to his question. And these, you almost make these assessments within your portfolio of which are going to be your core staple companies, which are going to be these engines for your portfolio going forward. And there are more opportune times to buy, as you said, looking at the RSI when those come down, looking for a pullback. The way I like to approach it is like with a stock like TD or Royal Bank, which over the past 20 years have just powered on, slow and steady grind, and we'd expect and hope that to be the case going forward. It's just like when you find these opportunities that just kind of pull back, you just keep nibbling, and you know, if you would have done that over the past 15 to 20 years and even further back, you would do just as well as hopefully we expect to do, doing the exact same strategy now for the next 15 to 20 years, assuming the banks stay strong and they keep paying strong dividends and whatnot. But it's a great example of how with a stock such as those, we do opt for, let's call it even it's not that we dollar cost averaged into these positions. We took more or less a full position. But it's with time, as more money comes into the portfolio, we would happily add to these and keep the position size relative to our entire portfolio, keep the ratios even. Maybe for a more specific stock that's more or less a play or more aggressive or something of that nature, maybe we are a lot more selective with the entry and exit points. But that actually sparked a new thought in my head, is that it depends on what company you're looking at. Right? Whether you decide to which way you're going to play it.
Well, and what you just said makes so much sense, because we know we want these companies in the portfolio. There's some other companies that we don't know today, and there might be an opportunity that comes up and we would factor all these things in. But we were just looking to get these in, and they will go up and down, and we plan to hold them for years and years. So we're going to have great times and we're going to have some rough times. And I would have no hesitation right now if it turns out our timing was bad. Those two holdings, Royal and TD focused on here today, dropped. Like you said, I'd probably be looking at picking up some more, because you'd be looking at another opportunity there just to bulk up the position.
Agreed. And with the other ones, they were more or less minor. Just a quick addition, as you said, to CNR. Nothing major there other than just, I think, averaging down slightly. What was the other one? Clorox, very similar position. And Canadian Utilities was a new one. Tremendous dividend, one of the most reliable ones. You guys know that. But I think one of the things to take away is it is a very nice feature on Wealthsimple trade, not worrying about commissions here, right? In this past month, we made 5 different stock purchases and not once had to consider a trading commission versus, if we would have spent that on Questrade or on another platform, well, that's 5 times $5, or that's 5 times $10. And that's just one of those costs that it is a benefit of using Wealthsimple Trade. And we're kind of showing that with the more generous amounts of purchases, the smaller amounts of shares that we're buying. And it really doesn't hurt you to bump up a position by three shares or by 2 shares, because it truly is a commission-free platform. It's cool.
Unheard of in the old days. Well, even when I got in the business, you couldn't. You had to buy 100 shares as a minimum.
A lot. Yeah, that's crazy. Yeah.
And so now you can go and add $50 or $80 if that's what you have available to put in.
I think you can even do $1. You can do $1 now that they have fractional trading, which I haven't really tried other than a test demo. But geez, $1.
Yeah, I'm not sure I'd want to do that, but heck, it wouldn't make the whole bunch of difference in the portfolio and the structure, but you can.
Not. You can. Well, hey, let's wrap up this video. I think we're about pushing 30 minutes in here, so why don't we just come through an overall overview and wrap things up today. So on the screen, I will put up the overall asset allocation breakdown of our portfolios, and these are the total. So the combined amount, basically. You have the Questrade one in and of itself, and you have the Wealthsimple portfolio, which we're still working it in. It's not quite there. As of today, we have 20 holdings overall. Our cash position as of last month was 40%. As of this update, that has been down to 24%. We increased our Canadian holdings with some of the names we just went over, just bringing more and more depth as we continue on. But feel free to pause the screen if you feel you'd like to look at these any heavier or any deeper, but I'll just kind of toggle them back and forth for you, and you can see how our portfolios are starting to take shape.
I will just add as well, if you're looking under sector allocation, we have now built the portfolio up over the last 3 months to have exposure to most sectors. And it doesn't mean you don't have to have exposure to all sectors at all times. We tend to at least have some weighting. The real estate sector, we haven't made any purchases in that sector yet. You will also notice on the chart that we have a category for international diversified, U.S. diversified, and Canadian diversified. And those are typically if we own equity ETFs, or if we were ever to buy a mutual fund that had exposure globally or domestically, that's where that would follow in. I doubt that we will end up, or it's less likely that we're going to end up with ETFs of the equity nature in there. But those are things that we possibly do, and in the the way I look after, I keep track of my portfolio. I do use this tool, and so that's something that you'll notice on there. But we're starting to see an actual portfolio, as opposed to the first update that we did. Yeah, we made some trades and we started building it, but it wasn't looking, it was very unbalanced at the time, and that's kind of what you'd expect when you're building it up. But starting to take some shape, so it's looking good.
And no rush either. We're a few months into this, and we're still not in any panic or any concern to go. We're just going with it, and that's, I think, the way it should be done. We're seeing opportunities today in different areas of the markets that we didn't see 4 months ago or 3 months ago, and I guarantee you 3 months from now there's going to be new things. So we don't want to put all our eggs in one basket, so to speak, or invest all of our eggs right off the bat, because then we're hooped.
I sure would love to see some more opportunities coming up soon. I mean, I'd love to see a healthy correction in the markets. Summertime and going into September, October, it's not that uncommon that would happen. So, I mean, nobody likes it when their accounts go down, like really likes it. But as an investor, you welcome those opportunities, you embrace them, because that's where you do get a chance to pick up some of these companies. You look back to every one of these corrections that we've had, and if you're doing it properly, it presents an opportunity. So I would love it. We have right now, around 24% still in cash, and I'd love it if we come back in 3 weeks or a month and we've been able to put a good chunk of that in because there's some opportunities came up. The top dollar value of our portfolio might be down, but that will be temporary, and so we'll see when we do our next update.
Why don't we wrap up this presentation for today? I want to thank everybody who's made it this far in the video, possibly even the podcast. I know a lot of you guys are actually listening via podcast. As a reminder, these are all put into audio form. If you do want to go check us out, you can find us at the Investing Academy podcast by searching that up on Spotify, Apple Music. You guys know the drill. But yeah, if you enjoyed today's video, take a moment and drop a big thumbs up, because that really does help out. Make sure you're subscribed and hit the bell for notifications. Especially very important to hit that bell for notifications these days, so that YouTube knows and they'll signify you and they'll alert you. We do always have our Investing Academy down below. So if you're an investor who wants to stay even more informed with this whole series that we have going on, you can get live updates when we buy, when we sell, how many shares, exactly what's going on. You don't have to wait a whole month for an update and then we talk back, because even in a month, matter of weeks, things can change. And it's not to say that we're perfect with our purchases by any means, but it can be an additional source of research for you, where you can factor that in, do your own due diligence, and make an assessment of whether it's an appropriate stock for you or not. But yeah, that's that first link down below. Dad, I'll let you enjoy the weekend.
Nice.
I'm probably gonna just be relaxing here, because that's been a.
I will just add, if you have a question, just a quick reminder, leave the question, because we really love that interactive point. And even if it's a matter of something like, well, you guys said this, I don't really understand it, or heck, I disagree with it. Love sort of that banter back and forth. So if you have a question that's come up, throw it on there. And unfortunately, we can't put everybody's questions, but we try and pick some that are representative. Or if you see a question you like, give it a I guess what do you give it a thumbs up, or you like the question, that'll move it to the top of the rankings.
Yeah,
so
good reminder,
please remember to do that. Yeah. And other than that,
I think that's about it. We can just, I guess, sign off for here. Thank you guys all for watching again. Thank you for the ongoing support of our channel here and everything that you guys do. Hope you guys are still enjoying this series, and I'm excited for next update. I'm sure we'll have some big moves. We got some decisions to make. In particular, I got some decisions to make with a couple of stocks in the Questrade portfolio, a couple of Chinese stocks which are going through something, but that'll be the whole topic of next video.
Maybe
next month. It could be the focal point. Yeah. Thank you guys all for watching. Dad, good to see you.
Good to see you, Brandon. Good to see
See you
everybody.
next time.
Bye-bye.
See ya.